Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video we're going to be going over FAR Area 1, this is Section F, and this is an application topic. Calculate liquidity ratios, such as the current ratio, the quick ratio, accounts receivable turnover, inventory turnover, and accounts payable turnover. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions. If you don't know much about our strategies, again, that is one of our main strategies, is jumping straight into the questions, because what are you going to be doing on test day? You're going to be answering questions, and you're going to be doing sims. You're not going to be watching lectures, you're not going to be reading a textbook, you're going to be answering questions. So it's best to learn how to answer questions and get used to learning from those rather than watching lots of lectures and things like that. So that's what we're going to be doing in this video. We're going to be going over 5 questions to learn how to do these liquidity ratios. And just letting you know, SuperfastCPA Pro members will have access to the full 10-question video that we post in the members forum, where we go over another 5 questions and you can get additional practice if you're a pro member. So if you like this and you want to learn more, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. We teach the key ingredients to passing the CPA exam, again, such as focusing on the questions, studying in the morning, doing mini sessions throughout the day. You can learn all of that on the webinar, and again, if you like it, you can become a pro member and get access to a lot more resources and help. Make sure you go check that all out. And with all that said, let's dive straight into the questions. All right, here we are at question 1. Something we always like to point out is read the last part of the question to give yourself context for the rest of the question. What is the current ratio for Linwood Enterprises? So if you know how to do the current ratio, we're going to read through this and you're already going to know how to do it. So let's read through this. Linwood Enterprises has the following balances on their most recent statement of financial position: cash $150,000, accounts receivable $250,000, inventory $500,000, prepaid expenses $100,000, accounts payable $350,000, short-term notes payable $200,000. So with all that information, we need to figure out the current ratio for Linwood Enterprises. A lot of you probably already know the current ratio. It's a pretty common one. If you don't know how to calculate it, that's okay. If you do, pause the video and do the calculation yourself, and when you're ready, come back, we'll look at it together. All right, here we are. The answer is D. 1.82 is the current ratio. So let's walk through this. The current ratio is calculated by dividing current assets by current liabilities. I'm sure you've seen that before. It measures a company's ability to cover its short-term obligations with its short-term assets. So can they cover the things that are coming up in the near future with the things that they're going to earn or that they already have for the near future? And current assets, just a reminder, is all the things that are short-term, less than a year. Cash plus accounts receivable plus inventory plus prepaid expenses, all of those short-term assets, current assets, that equals to, in this case, $1 million. And then the current liabilities, similar idea, all the things that are due within less than 1 year. Accounts payable, short-term notes payable, those are the things that are typically around there. So you add those together, that's $550,000, and then you divide current assets by current liabilities. Again, that's the current ratio, is current assets divided by current liabilities. 1 million divided by 550,000 is 1.8181, or really just rounded to 1.82. So with that, what does that mean? The ratio of 1.82 means that for every $1 of liabilities, the company has $1.82 of current assets to cover them, indicating strong short-term liquidity. Basically, they have $1.82 of assets that they can use to cover every $1 of liabilities. So that's good. They have more than enough money according to this ratio. So that's the first liquidity ratio we wanted to go over. We went over the current ratio. Let's go to the next one. All right, here we are at question 2. As always, read the last part of the question first. What is the quick ratio for Cypress Corp? Again, if you know how to do the quick ratio, then you will know how to do this as we read through it. If not, that's okay, but this is giving us context. Now we read through, knowing that we need to look for the quick ratio. The balance sheet provides the following information: cash $75,000, accounts receivable $100,000, marketable securities $50,000, inventory $120,000, prepaid expenses $40,000, accounts payable $130,000, and short-term notes payable $70,000. So with all that information, we need to figure out the quick ratio. Now this is very similar to the current ratio, and again, if you know how to do this, you know that it's just a little bit different. There's a few things that you don't include in the quick ratio. If you know how to do it, pause the video, do the calculation. If you don't, that's okay. We're going to dive straight into the answer to learn it together. All right, here we are. The answer is A. 1.13 is the quick ratio. So let's read through this. The quick ratio is calculated by dividing the most liquid current assets, so only the most liquid. So that would be cash, accounts receivable, and even marketable securities. And then you take that and divide it by the current liabilities. So current liabilities doesn't change from the current ratio to the quick ratio. It's the assets that you're focusing on in the quick ratio that's a little bit different. It measures the company's ability to cover its short-term liabilities with its liquid assets, its assets that it could use right away. So that would exclude inventory and prepaid expenses, because those are the kind of things that they don't really have control over, or very good control over, of how quickly they can use them. But cash, accounts receivable, marketable securities, those are things that they can use really quickly to get money if they need to cover their short-term liabilities. So quick assets is the cash plus accounts receivable plus marketable securities. It doesn't include inventory or prepaid expenses. Just remember that. So you add that up. In this case, it's $225,000. Current liabilities, again, similar thing, accounts payable plus short-term notes payable, or any near-term payables or short-term liabilities. And that's $130,000 plus $70,000 is $200,000. So you take the quick assets divided by the current liabilities, and that gives you, with this quick ratio, 1.125, or if you round that to 1.13. What does that mean? Now, very similar to the current ratio, this means that they have $1.13 in quick assets for every $1 in current liabilities, indicating that it can meet its short-term obligations not just with current assets, but even with their most liquid assets, they can cover their short-term liabilities. So it's a little bit more limited in its scope. One other way you've probably heard this ratio, instead of quick ratio, a lot of times it's called the acid test ratio. So acid test ratio, quick ratio, same thing. It is focusing on the liquid assets, not just the current assets, but the liquid assets over the current liabilities. Let's go to the next question. All right, here we are at question 3. Let's read the last part. What is the accounts receivable turnover for Greenleaf Manufacturing? Okay, so accounts receivable turnover. If you know how to do this, that's fantastic. The financial team at Greenleaf Manufacturing is analyzing its efficiency in collecting receivables. The company had the following information for the year: net credit sales of $925,000, beginning accounts receivable of $85,000, ending accounts receivable $110,000, cash sales $275,000, inventory $345,000, and prepaid expenses $45,000. So with all that information, there's a lot of information there. What is going to be used to calculate accounts receivable turnover? Now, if you know how to do this, that's great. Pause the video, again, do the calculation. If you don't know how to do it, that's the whole point of going through these questions, is to use them to learn how to do things. So let's go ahead and go to the answer if you don't already know it. All right, here we are. The answer is 9.49. That is the accounts receivable turnover throughout the year. So let's read through and kind of understand what that even means. The accounts receivable turnover ratio is calculated by dividing net credit sales by average accounts receivable. This is very important, by the way, net credit sales. I have seen in some different places that people are using sales over average accounts receivable, and I guess you could use that if it's implied that all of the sales were on credit, but you need to know that it is specifically net credit sales over the average inventory. It's not just all sales, because if a company has cash sales, you're not going to include those in this accounts receivable turnover, because accounts receivable turnover has to do with the sales you did on credit, therefore meaning that it was a receivable, and then seeing how often you get the money for that throughout the year. If you have a cash sale up front, that means there was never a receivable from that sale, so it's not going to be a part of this calculation. I've seen that before, so I don't know why that's out there. It's specifically net credit sales. So just remember that. The irrelevant information, like I said, is cash sales, inventory, prepaid expenses. All of those things don't go into this. So first we have to calculate the average accounts receivable. We talked about calculating the average of something in the previous video where we were talking about profitability ratios. You take the beginning of the account and the ending of the account. So in this case, the beginning accounts receivable and then taking the ending accounts receivable, you add it together, divided by 2. We all know how to do this. That's how you get the average. That is the average accounts receivable throughout the year. So $85,000 plus $110,000 divided by 2 is $97,500. So with that, now we can calculate the actual turnover, which again is net credit sales over average accounts receivable. So we take the $925,000 of credit sales that was up there, and we divide it by the $97,500 of average accounts receivable, and that gives you roughly 9.49 of accounts receivable turnover. That means that throughout the year, they collected their average accounts receivable approximately 9.49 times a year. So throughout the year, they were able to collect their accounts receivable almost 10 times throughout the year. That's pretty good. So that is the accounts receivable turnover ratio. Again, remember, it is specifically net credit sales. I'm not sure why some places say all sales over average accounts receivable. It's specifically credit sales that you want to look at. Let's go ahead and go to the next question. All right, here we are at question 4. As always, read the last part of the question to get context. Based on the information given, what is the company's inventory turnover ratio? So probably pretty similar to the previous one where we were talking about the accounts receivable turnover ratio. Let's walk through this. Anderson Shipping reported the following information for the current year. They had beginning inventory of $120,000, ending inventory $150,000, total purchases $400,000, sales revenue $950,000, operating expenses $200,000. So again, we have to calculate the inventory turnover for the year. So with the information we have, we need to figure that out. If you know how to do this, or if you have a general idea, of course, pause the video and do the calculation yourself so that you can see if you got it right. If not, that's okay. We're going to dive straight into the answer, no problems, and look at it to see if we can learn what we need to know. All right, here we are. The answer is A, 2.74. That is the inventory turnover in this case. Here is the calculation or the formula for inventory turnover, COGS over average inventory. Pretty simple. In this case, though, you had to figure out COGS, so we're going to go through that to kind of remind you how to do that. So first we have to calculate COGS if we didn't already have it, cost of goods sold, using the beginning inventory, the ending inventory, and the total purchases. So just as a reminder, you take the beginning inventory, you add the purchases, and you subtract the ending inventory, and that tells you the cost of goods sold throughout the year. So $370,000 of cost of goods sold in this case. And then we also have to calculate the average inventory. Again, very easy when you're given the end of year inventory for the previous year and end of year inventory for the current year, because that's technically the beginning of year inventory and the ending of the year inventory. So you add them together, divide them by 2, and that gives you the average inventory for the year of $135,000 in this case. Now that we know the COGS and now that we know the average inventory, we can calculate the inventory turnover. So that's COGS divided by average inventory, giving us 2.74 of inventory turnover. Now that means that Anderson Shipping turned over its inventory approximately 2.74 times during the year. Sales revenue, operating expenses, those other things that were up there were not relevant. All you need to know is how to figure out cost of goods sold if you're not given it, or if you're given it, then that's super easy. And then you also need to figure out how to get the average inventory. Again, not too difficult as long as you're given the beginning of the year inventory and the end of the year inventory, or even the end of the year inventory for the previous year, which is again the beginning inventory for this year and the end of year inventory for this year. So that's another liquidity ratio. Let's go to the next one. All right, here we are at question 5. Let's read this. As always, the last part of the question. What is Larkin Manufacturing's accounts payable turnover for the year? Okay, another ratio, a new one that we haven't seen yet. Larkin Manufacturing has the following financial information for the year. Total purchases, $825,000. Beginning accounts payable, $65,000. Ending accounts payable, $85,000. Cost of goods sold, $900,000. And sales revenue, $1.2 million. So with all that information, we have to figure out the accounts payable turnover. Again, as always, if you know how to do it, this is a great time to pause the video and make sure you know how to do it by doing the calculation yourself. If not, let's go ahead and go to the answer. All right, here we are. The answer is D11. That is the accounts payable turnover for this problem. Now, this is another one that I want to make sure is really clear. Accounts payable turnover is supposed to be total purchases divided by average accounts payable. I'm going to talk about why you might have seen something slightly different in a whole bunch of different places at the bottom here, but the normal accounts payable turnover is total purchases divided by average accounts payable. So what is the point of the accounts payable turnover ratio? It measures how efficiently a company is paying off its suppliers during the year. So accounts receivable turnover, how quickly are we getting our money after doing these sales? Accounts payable turnover, how quickly are we paying people for things that we're purchasing on credit? It is calculated using the following formula. Like I said, it's total purchases divided by average accounts payable. So the total purchases, if it's given, it's probably just going to be given to you. So that would be $825,000 here, and that is directly related to the purchases from suppliers. Then, as always, average accounts payable, pretty easy to calculate if you remember how to do it. You take the beginning accounts payable at the beginning of the year plus the ending accounts payable at the end of the year divided by 2, and that gives you the average accounts payable for the year. So in this case, $825,000 divided by $75,000 is 11. That means that they paid off their accounts payable 11 times during the year. That's pretty darn good. Now, this is what I was trying to get at. Normally, it's total purchases over average accounts payable. However, you probably, or you may see this in the exam potentially, many people use COGS instead of total purchases in calculating accounts payable turnover because COGS is more readily available in financial statements while detailed purchase data might not be. Since the cost of goods sold is closely tied to purchases made from suppliers, it serves as a reasonable proxy. So a lot of people do use COGS instead of total purchases because a lot of times they just have easy access to COGS rather than the total purchases. This approach also maintains consistency across financial ratios because inventory turnover is using COGS, and it simplifies the calculation when inventory levels remain relatively stable. So if your inventory is pretty stable, it doesn't change too much, you're buying and selling roughly the same amount typically, then COGS is a great way to go. However, using purchases is more accurate when inventory levels fluctuate significantly, as COGS may not capture the full picture of credit purchases. So this is something you may see in the exam. You may see that they want you to use COGS over average accounts payable, or you may see that they want you to use total purchases. It depends on what you're given. If you're given just a basic income statement and a basic balance sheet, a lot of times it probably won't have the purchases information, so you can just use COGS. But if you are given the purchases information, the total purchases, then the correct / more accurate way to calculate accounts payable turnover is total purchases over average accounts payable. So that is another one of the liquidity ratios. We've gone over 5 in this video. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you how to calculate inventory turnover, or you've seen 2 or 3 questions trying to teach you how to calculate the current ratio, things like that. These are the things that keep popping up. So you know they're important. You know they are pillar topics or key points that you need to take note of. So you write them down, maybe summarize them in your own words so that you have them and you know them for later. So as you're going through the material, you're picking out the most important things as you go. Let's go ahead and go to the pillar topics for this video. All right, here we are at the pillar topics for this video. Let's just dive straight in. Let's go over the current ratio first. Remember, the current ratio is current assets divided by current liabilities. What's the point of the current ratio? It measures a company's ability to meet its short-term obligations using its current assets. A higher current ratio indicates better short-term financial health as the company has more assets available to cover its liabilities. That's a pretty common one. You've probably seen that in your normal accounting job potentially. Now, the quick ratio, there's the other name for this is acid test ratio. This is very similar to the current ratio, but it's a little bit more limited in its scope. It's specifically the liquid current assets, so cash, marketable securities, accounts receivable, all those added together are the quick assets, and you divide those by the current liabilities. This provides a stricter measure of liquidity by excluding inventory and prepaid expenses, focusing only on the most liquid assets. A higher quick ratio indicates the company's ability to quickly meet its short-term liabilities without relying on inventory sales. So again, those two are very similar. Let's go to the next one. Accounts receivable turnover. Remember, it's net credit sales, not just sales, it's net credit sales divided by average accounts receivable. This shows how efficiently a company collects its receivables from customers. A higher accounts receivable turnover ratio indicates faster collection of receivables, meaning the company is more efficient at converting credit sales into cash. So again, the reason that it's so important to remember net credit sales is because accounts receivable means that the sales were done on credit. So you're trying to see how quickly you are taking those sales on credit and actually getting the money back for those. If you have cash sales, it's not going to affect net credit sales because you already got the cash for those. Next is inventory turnover. This is cost of goods sold, or COGS, divided by average inventory. This measures how efficiently a company manages its inventory. A higher inventory turnover ratio indicates that the company is selling and replenishing inventory quickly, reducing holding costs and improving cash flow management. So again, it's how quickly they are getting their inventory out and potentially in as well. Now, last of all, accounts payable turnover. Remember, this is supposed to be total purchases divided by average accounts payable, but that may not always be available. You may not always have the purchases amount. You may only have COGS. So if that is the only information you have, then you can also calculate accounts payable turnover with COGS divided by average accounts payable. So you may see that on the exam. So I just wanted to make sure you know it's supposed to be total purchases divided by average accounts payable, but you may need to use COGS instead if you don't have the purchases information. This assesses how quickly a company pays off its suppliers. So similar to accounts receivable turnover, where you're seeing how quickly you're getting money back from sales, this is seeing how quickly you are paying people off for the purchases you made on credit. A higher accounts payable turnover ratio suggests that the company is paying off its creditors faster, indicating good cash management and relationships with suppliers. So these are the 5 ratios listed in the blueprints for liquidity ratios for the FAR exam. We've gone over 5 questions to teach each one. Thank you for watching. If you liked this, make sure to go to SuperfastCPA.com and check out our free 1-hour webinar training. Remember, we will teach you the key ingredients to passing the CPA exam, and after you watch that, you'll probably want to become a pro member. And remember that pro members do have access to the full 10 question videos that we make for these, so you can see those in the forum and get more practice and more understanding. If you liked all this, make sure to like the video and leave a comment. I hope this was helpful, and I will see you in the next video.